Mystery, I'm getting you set up. Not sure why you use 99. Why did you use 99, Alex? Mystery Trader 99. Happy New Year, buddy. Welcome back to F.A.C.E.
Thank you. Can you hear me?
Got you.
Perfect.
Got you,
Let me do share screen.
So why 99? Were there 99 mystery trades that you did?
No, that's actually when I started trading. So that's basically the first year.
Oh,
So,
okay.
Yeah.
So. Well, that's important.
It is. It was quite a time.
All right. So, Happy New Year to
Happy New Year to you as well.
I hope you didn't start trading in 99 by being overly bullish the market.
No.
That would have been a really, really bad juncture.
That would have been really bad, no.
Yeah.
No, he was bearish when he started. So, right, buddy? So,
yes, it was.
Interesting now, a couple of things that from your last interview, I know you always come here well prepared with a nice PowerPoint, but just a couple of questions before you go.
Sure.
Just the dollar did not hold 92, got down into 89. And I think
Correct.
it's just hugging that uptrend line. Is that a breakdown for you? And you could address it during your thing. And the second would be Euro pound has been under pressure, and we know for the narrative of parity, it needs to go the other way. So I would just say, are those two things challenging?
We are actually going to discuss that, but I'm actually glad you brought that up. So
okay,
definitely within the.
See how I remember?
Yes, you did.
Your
Absolutely.
interview. Yeah,
absolutely.
So, okay, so why don't you just go ahead and everyone? Mystery has a very nice following. He's a mentor. He teaches. He shares research, and this is what your fifth time here, fourth or fifth time here?
Sixth time. This is
Sixth. Oh, God, I always underestimate. So, take it away, my trading warrior brother.
Absolutely. Thank you, Dale, again. Happy New Year again, and I hope you're doing well. It almost didn't happen today. Actually, yesterday I had like the worst corneal abrasion of my life, and I literally was in agony yesterday. I couldn't even see out of one eye. So, pardon me if I'm reading. Yeah, it was pretty rough.
How'd that happen?
I woke up in the morning, all of a sudden, just excruciating pain. I was in the bathroom for 2 hours, just trying to, I don't know what happened. Something happened, but anyway, so I'm blurry in one eye. So if I ever kind of stumble or I'm trying to read my notes, it's because I'm literally doing this with one eye. So I appreciate your patience.
Yeah. Okay,
professionals
buddy.
don't make excuses.
Hope it heals by the end of today.
Yeah, it takes a couple of days usually, but yeah. Anyway, okay. So this is obviously part 6 of the global Forex parity, entitled "Setting Up for the Turn." For those of you that play Texas No Limit Hold'em, you understand the reference. It's the second to last turn before you get to the river. And kind of want to first, I'll do a recap of what happened in part 5, what was incorrect, what was correct. First, it said gold weakness would continue, was going to form unexpectedly. Biden victory would have a smaller piecemeal stimulus in the short term, and then equity markets would initially pop on a Biden victory. Now, the part that I didn't get correct was after the election pop, I assumed there was going to be a reversal, but if you remember correctly, the week after he got inaugurated, that Monday morning is when the vaccine news hit. Obviously, when that came, that was basically a green light for all risk assets to go gangbusters. So that obviously didn't come true. And then energy was going to get hit on Biden. That also too was reversed because once the vaccine news came, that basically incentivized travel, leisure, and energy consumption. So that also didn't allow any energy to have one last hit, which it was actually about to roll over, technically speaking, but literally the news saved the entire energy sector. And then the other part was the delayed stimulus. I thought once Biden got in, they were going to try and stall all the way until after inauguration, but sure enough, they actually did a QE5 ended up being QE5 light. It was kind of like a piecemeal 900, quote unquote, only 900 billion. It's crazy that we live in this age where that's only, but that happened. And then
so the QE5 light was fiscal.
Correct.
So you also consider fiscal as QE?
I do, because during the 09 crisis, some of the QEs were technically also fiscal stimulus from Congress. So I kind of grouped them into one category. Okay. And then QE6 will be what this next supposedly $2 trillion, we don't know the exact number yet, but whenever Biden gets in and Congress reconvenes, we'll know the exact dollar amount. But estimates are saying roughly around $2 trillion.
Okay.
So from there, first we'll do a Forex update of kind of the big pairs, an update on the narrative. This is obviously the euro dollar chart. Obviously, it's broken out of the 10-year channel. This does not necessarily invalidate global Forex parity from a theoretical standpoint, but because it broke out of the channel, now the timing becomes more challenging because we don't have that channel as a guide anymore. But nonetheless, that window is still very wide. It's entirely possible it could still play out. And we'll kind of go through the narratives, and I'll show you my thesis throughout the presentation. You'll see how there are still signals that we are at a potential turning point here soon. Okay. This is the pound dollar. This is the 20-year chart, and if you look at the 13-year channel, it's still within that channel, but it is pressuring it currently at the moment. Right. If you see any sort of rejection here of the stochastics at the center line, that would be a potential signal that the purple trend line is actually going to hold. But basically, we need more time for this to play out. There's no confirmation signal yet. Okay. And this kind of 120.25 level, that's a major hard support on a closing basis. So that would need to be breached before any potential run to parity would occur.
Okay.
And then on the pound euro, this also, as I've said many times before, this is actually the most important pair. And if you look going back to the previous orange support trend line, it had a slow rising trend line and it rejected at the 50, similar to this purple arrow. And then now it's kind of in this last final phase. Until this actual orange trend line, support line breaks, there's absolutely no confirmation of any sort of move to parity. So really that's the key level. And I think right now it's right at 110. So it really needs to break below that level for there to be any sort of a confirmation to the downside. But for right now, it's still playing out and still holding. So it's more of like a lateral consolidation. This is still well within the channel. And of all the pairs, this is actually the most important. I know you normally ask, why don't you normally do euro pound? So just for you, Dale, I went ahead and introduced this new chart. So this is now the entire history of the euro pound inverse of the previous chart. And if we look at the entire formation in aggregate, what we see is actually a huge ascending triangle. It's actually a large macro ascending triangle between the magenta and the purple, and then also a minor one, which is the orange trend line forming an even steeper ascending triangle.
Oh, great look.
Yeah. So, and if we look here, looking using the MACD, these are custom MACDs, by the way. These are refined specifically for the euro pound. If we see the last time we had this sort of formation, it was the cyan box between the 2003 and 2008 period. And during that period, that actually ended up being a consolidation period, which is what's shown right here in the green box on price action. And it had multiple bounces off the 50 moving average before a final consolidation, and then it ended up breaking higher. Right now, we're still in this kind of consolidation process. And if you notice, the 50, with the exception of this one little blip, is actually tending to hold that 50 support line. So, and more importantly, the upper resistance on a closing basis is right at the 93 level. So in order for any sort of confirmation of race to parity, that's really the level you need to keep watching out for, is that 93 level. If it can break out above there and close and stay above that on a monthly basis, then that's your sign that there's hope of it actually making a run to 1-to-1. The only time it's ever actually broken above that and closed above it was during the 08 financial crisis.
Oh,
sorry,
yeah.
Right here and right here. And so that was the only time, and it got close. It got to 98, so it was knocking on parity, but it never quite got there. So really, what we need to see is some sort of consolidation in the center line of the MACD. If we can get some sort of support here, right now it's obviously rolling over a little bit, but if it can kind of hold this level a little bit longer, then there's possibility. But if you look at the minor ascending trend line, it's still got a bit of time to fill out. So it doesn't necessarily have to make a move yet. So I would exercise more patience and caution in the short term regarding the euro pound.
Yeah, it could even pull back to, looks like with that chart, you have some bands around 887. And that's where the trend line, the red one,
yeah, red one is the 50. That's the 50. Yeah. So, okay. And it could easily, I mean, if you see there's a confluence between the orange trend line and the 50, so it could easily bounce, come down here and then rocket off. Okay. So that's entirely possible, yes. And that's kind of what actually the MACD is suggesting right now by crossing bearish. It may have, one more pullback and then base and then go. But right now, this, of all the pairs, this is by far the most important, because without euro pound going to parity, everything else is kind of irrelevant. So, and interestingly, if we talk about the euro pound, what I found very interesting about this one was when Boris said, this is regarding Brexit, he said, the UK people, quote unquote, gain control of their currency once again. When I heard that immediately sparked the thought of competitive devaluation. I mean, when he's saying we finally have control of our currency again, well, why does that matter? I think what he was basically saying, a hidden signal, is that in order for them to become have a competitive advantage on a global scale, they're going to have to devalue their currency in order to, boost their economy, increase inflation, and so on and so forth. So I think that was kind of the main premise I got from his recent speech, when, the victory speech of Brexit and finally getting the deal done. To me, that is also a potential signal that they're looking to devalue the pound.
What's strange about that is they weren't in the euro. They kept cable outside of the currency. Yeah.
But
so why did they have more freedom now to debase?
Well, because they have a lot of these political alliances. There's a lot of restrictions on trade and so on and so forth. So by doing the deal, I'm sure somewhere in that deal gave them more flexibility to be able to move their. I mean, obviously the currency's moving, but a lot of times there were controls in place from the ECB to kind of keep things in check. At some point, I think they may actually kind of let it devalue here. And so if that were to happen, obviously this 93 purple level would get taken out to the upside, and then that's when you have a real breakout.
That's a great looking chart.
That's just again, that's purely a theory. But when I heard that, immediately the thought that came to mind was competitive devaluation.
You ultimate contrarian, you.
And then, well, obviously we can't, discuss things without talking about the $40,000 elephant in the room, which is of course crypto and Bitcoin. So this is the previous. This is the chart, the weekly chart of Bitcoin, going back all the way to the 2017 peak, which is right here. And obviously, I said there was a descending trend line, the purple one. And if that ever broke out, which was, I think, two in part 4, then we were going to retest the highs. Well, we definitely retest the highs and then some. So we obviously have gone off, and we had a major price discovery moment. And if you notice here, the last time the RSI peaked at 90 and formed the shape was all the way back at the 2017 peak, which is right here. You can see kind of form a very similar formation. And then if you look in the MACD, this is actually the, stochastics. If you look at this, you can actually start to clearly see a 5-wave structure forming, which ends in a plateau similar to here, and then it eventually rolled over. Now, the only thing that's debatable here is whether we want to put wave 1 here or put wave 1 here, which would be a very extended wave 1. Based on from price action, but nonetheless, it is a 5-wave structure, which is now culminating at what is now essentially a large, this magenta bull channel. During the peak back in 17, it also overshot the upper Bollinger by an extreme amount, and then formed a very large red bearish engulfing candle. Now, this week is still not over yet, but if it becomes bearish engulfing, that could be a potential sign that maybe this move is finally exhausted. And then interestingly, this little red drop indicator indicates that from peak to trough, the last Bitcoin cycle dropped 84% before it found a base, and then started to build support, which was actually right at the 200-day moving average. I'm not necessarily it has to fall 80%, 4% this time, but I mean, there's definitely a lot of froth in the market right now. I mean, you see people coming out calling for 2 million or 1 million Bitcoin. I mean, there's these crazy price targets. Anytime you start seeing a lot of that froth, that's usually a sign that things are kind of maybe coming to a short-term peak. Now, long-term,
perhaps we could get a pullback to 14 grand or so.
I actually do think that, yeah, that's roughly where actually 14 is actually right where this green VBP level is, volume by price, and then also the magenta support. And it's now forming a large bull channel. So one would think, higher highs, higher lows is going to be the trend moving forward. But the fact that, the stochastics are forming a potential wave 5 plateau top, once the magenta trend line of this ascending triangle fails, that's usually when the bull ends. So we got, timing wise, we're close. We got a little bit longer, but maybe another month of kind of chopping. Initially, when it did here, it still had a secondary pop before it actually ended up failing, rolling over. So it's a process. It's not going to be instantaneous, but within the next roughly month or so, you'll see some sort of a thing. But the other interesting thing is, whether or not when I see this kind of price action, remember I told you last time or previously episodes that there's only majority of the Bitcoin, the staggering majority are really in 90 accounts hands. So it's a very concentrated, very tight market. And now they're talking about liquidity concern and so on and so forth. To me, that's usually the signs of some sort of coercion or some sort of cooperation where these big players are actually working in tandem with one another in order to restrict supply artificially, which is why you're getting these huge, massive price discovery moments. And I'm sure they're dumping into this. I mean, this is what they do. They dump and then they reload and so on and so forth. So just, caveat emptor, if you're interested in buying Bitcoin, just understand the risks right now. You're really buying into a very elevated valuation. If you want to buy for the longer term, if that crypto is your thing, you want to wait to get back to some sort of a hard support of some kind, which would be back, towards the lower end of this channel once again. Is it going to go back to 3,500? No, I don't think it's going to go down there, but I do think, we'll have some sort of a correction once again, and things will kind of return back to normal.
Okay, buddy.
Okay, and then of course next we're going to talk about bond update. This is actually we discussed this last time. This is the TNX, which is essentially the 10-year Treasury yield. Back when we met earlier this year, it was literally within days of the actual low, and I said that this is starting to look like a major bottom. And sure enough, we were in agreement together that was kind of looking like I think it's 43 basis points was the final low, roughly around there. And then since then, you've seen the MACD form a major bottom and ultimately bull crossed. Same is true. The stochastics is forming a nice kind of parabolic ramp here. These are all very healthy signs of a yield breakout. Now, if we compare this to the most analogous previous period, that would be the actual 2012, 2013 bottoming cycle, where yields bottomed. They popped up into the Bollinger center line, which is what we're doing exactly right now. And then there was a 3-month kind of bull flag consolidation before yields actually broke out. So you had the red arrow, there'd be a purple arrow here sometime around roughly March, April. And then from there, you're going to have the major yields breakout. Well, why is this important? Well, if you we'll look at it in a second and it'll make more sense, but just remember that 2012 is a very important confluence period for a lot of different asset classes. And I'll kind of be a theme throughout the presentation. But note that this is also where the previous gold peak happened. It was right before yields completely broke out. And then the huge flush happened once yields actually broke out. So just keep that in mind. We're about to discuss it in the gold section, but that's why, people forget that gold is not just inverse dollar. And more importantly, it actually tracks bonds more than anything else. So you have to, always pay attention.
All about yields.
It's all about yields. I mean, everything is amazing. It's one of the most overlooked asset classes, but 10-year treasuries, it dictates so much in the markets these days. So and then once we go through, we'll start here with the gold. So we discussed this last time, and I think this is a very important chart. This is the quantitative easing analysis chart, where I kind of analyze all the previous QE periods, both on a timing and price standpoint. If we look at the previous cycle, initially I thought that QE QE1 and QE2 were joined in QE4, and then QE5 would be the last of it because I thought it wasn't going to happen until after the election. Well, the fact that we got this, piecemeal, QE light, then basically it, the pattern is it comes in threes. So now we're going to have a third and final quantitative easing. I think this one will be the last one because the inflationary expansion after this, they're not going to be able to justify a fourth QE. So I think this next one that comes under initial Biden administration will be similar to the one that, similar how Obama, when he got into office. I think this will kind of be, because the cycle started earlier, I think this will be the last of the three of the quantitative easings. And if you look, the magenta, the yellow, and the orange, these are all the starting points of the QEs. And if you look, this was over a very wide period. It's almost 3 years, 3 full years from beginning to end of the QE cycle, and then QE3 ended at this red line. Well, look now, I mean, the magenta and the yellow are so tightly compacted, they're really cramming these quantitative easings in a much tighter, shorter period. And this has more of an explosive effect on risk assets, inflation, and so on and so forth. And if we look at the MACD, we see that it's also forming a very similar period as the orange box back in 2011 and 2012. This is roughly the same levels where we're peaking, and now the MACD is about to roll over and cross bearish. So signs are that, this last and final one, we may get one more pop here back up because the 13 moving average and the Bollinger Center are too far apart still for there to be a breakdown. So if we were to compare to last cycle, we're right here, which is where this orange divergence occurred last time. This is where we're at right now. So you can see there was 1, 2, 3, 4, 5, 6, 7. It was still 7 more months before it ultimately peaked. Now this cycle is obviously faster, but I still do think we get some sort of a consolidation on gold above this purple level. And when I was on Charts Coach, when we were back originally last time, we were roughly around the 1950 level. I said we were going to drop to 1756. We got close enough. We got within the 1760s, and then from there, I said we were going to pop back up to the 1950s. And if there's any rejection at 1960, that would be a sign that we're repeating the 2012 cycle. Well, sure enough, that happened in the past few weeks. So the fact that we're starting to see some sort of rejection here in the 1950s means we're going to revisit that kind of 1780s level once more, I think, before we have a final a pop back up into the 1950s. So it'll be kind of a topping channel, and we'll cover this in.
So not 2200 after this pullback?
So I'm actually, I'm glad you brought that up. So let me see if I can jump ahead. Actually, no, we can do that. Actually, we'll do that next. Yeah. So if we go here, this is actually the gold DXY ratio chart. So this covers, gold versus the entire basket of U.S. index basket of currencies. And if we look at this one, this actually provides a lot more context because
it was a lower high.
Yeah. Not only that, but when we first our first interview, part 1, was actually May of 19. So we were back in the 14s. And back then, obviously, I said there's a lot more upside left. And sure enough, we went all the way up to 22.5. And this 22.5 level has been a major resistance, 1, 2, 3, 4, 5 rejections at that level. The only other time it popped above that was in 2011 when we had the previous peak at 1920. But if you look here, it's starting to form another divergence, and you have the MACD rolling over at the same level it did back in the 08 period, and then you have stochastics looking very similar to the 2011 period, all of which were peaks. RSI is also indicating that was a major peak here in the red circle. So it is also as you said, a lower high, and to me that's very important significantly because when that happened, usually gold, it should have gone and reached a new higher high. And when we show the DXY chart in a bit, it'll explain why. Because 2100 peak, that was back when we were at DXY was at 92. Well, we're already below that, and gold is still struggling to get back up above 1900. So to me, that's a sign that gold is already in a state of relative weakness because it should have already broken out to my 2237 target. but it never did. So it's important when you see these things where signals are not forming. Why is that? What is going on? And I think we'll discuss that here in the next few slides. But it's important to know that this is a major long-term resistance zone, and it's also suggesting that both gold will have to peak and DXY will have to bottom here soon, which obviously ties into global forex parity narrative. Now, is it possible we're in a period similar to 08 where this is just a short-term consolidation and it drops back to the 50 moving average and the magenta, which is also, there's a confluence zone here as well. And then there's a super bull after this huge dollars, move. Absolutely. And that's also a possibility. But I'm more inclined to say, because we're at this 22.5 level, that this is actually a major, I think this cycle is peaking here at this. I don't see 21 being taken out, and I'll show more evidence as to why I think that.
Okay.
We've never discussed energy before, but obviously this is something I wanted to cover given the current market dynamics. And this right here is actually a very interesting chart. This is actually a 35-year chart of WTI versus gold and West Texas Intermediate, which is obviously U.S. crude. And if you notice here, this key orange support level is right at the
COVID crash low.
Yeah, 0.03. Well, if you convert it to percentage, that means this is roughly when when oil hits 3% of gold's value. That's been a long-term hard support. It happened in 86. It happened in 89. It happened once again in 2016. And these have been major bottoms. Well, this recent one went all the way down to 0.005, which means 155-gallon barrel of oil was worth half of 1% of 1 ounce of gold. I mean, it's pretty crazy when you think about just how extreme. And this actually is the 140-year low of the WTI gold ratio.
Wow.
Why is that significant? Well, the reason it's 140 years is because that's when oil was discovered in Pennsylvania roughly 140 years ago. So basically, that's from the very beginning until now, that was a very important, significant level. And that basically, if you look here, now you see that the MACD is crossing bullish, just as it did in 2016 before the next bull market started. There was also one in 09, and then also one back in 85. So you can see all major bulls start when this formation happens. And now we're actually going back and back testing that 3% level. Full disclosure, because of this, I'll ask you a question, Dale. What do Texans like more than yellow gold?
Okay. Beverly Hillbillies.
Yeah, the black gold.
Yeah.
The one thing we love more than
Texas tea.
Exactly. Texas tea. So when I saw this ratio hit this level, I actually ended up selling half my gold position, all of my silver, and rotated into energy at that bottom.
Wow.
Yeah, that doesn't mean I don't have a long-term gold narrative. I do think long-term it's still going to go very much higher, but on a relative basis, you're not going to get another opportunity like this in your lifetime to transition from one asset class to another. So on a relative basis, I couldn't ignore the fact that this is the cheapest oil we'll probably ever get in relative to gold. And not just because it went to negative 37 a barrel. This is not even including that. This ratio bottoms when on a closing basis when oil was I think it was like $15 or $14. It was some real absurd low.
Very interesting look.
Yeah. So, and more importantly, this is back testing the Bollinger Center, which is the last kind of hurdle before this really turns into a major bull. And most importantly, this ratio also peaked at 16% when it was back in 2005 and in 2008. And this was actually the all-time peak at 147 a barrel. So this is just to give you some kind of context of where we are relative to one another, because this is ultimately the real price of oil, outside of any fiat currency. It's essentially where you're pricing oil in gold, because that's basically, it takes out that any sort of kind of currency fluctuation over long term. So that's an important thing to note. And then also we're going to cover U.S. equities. I think this is very important because you guys were discussing it earlier this morning. So this is going to be a macro analysis of the entire Dow Jones 30 on a monthly basis. And once we take a step back, this right here at the far left is the 2009 bottom right here. And then you can see the huge uptrend. Well, we had the big scare of, where was 2015, in 2016, there was a major consolidation period. And then you had another major breakout where anytime you have a recession, it drops back down and then it retests that high. And from that point, there ends up being a bullish breakout and a bullish extension moving on to new highs. Well, the same thing happened in 2015, 2016. You went down, you tested the 50 monthly average, and then you went back up. And once it retested that previous high, there was a 2-candle bull flag, and then it broke out. Well, what do we see here? We had a major recession. It pulled back. Obviously, it was sharply induced because of a pandemic, but nonetheless, we had a recession, pulled back well below the 50 moving average. It actually went and retested the previous high of the 2015-16 period perfectly. I mean, almost to the penny intra month, and then it popped back up, and then now went to go retest, close to retesting that high. What happened? Had two red candle bull flag, and now it's starting to break out. Well, why is this important? Well, in the 2012 and 2012 period before it broke out to when it actually peaked, it actually rose almost 32%. Market expanded roughly 32%, and that was over roughly almost a 24-month period. Well, in 2015, 2016, when the same pattern formed, in roughly 14 months, it went up 40%. Now, you would normally think as markets go higher, the percentages should actually decrease, but what we're seeing here is the exact opposite happened. So it's actually increasing or accelerating. This also coincided with a stochastics kind of green V bottom, which we're seeing now here as well, and a MACD bull cross, which we just got. So as cautious and bearish as everyone may be, the RSI is nowhere near its previous peak levels of any sort of top. It's still got room to run. And we just broke out of that previous high, which means from there, normally you'll see some sort of very strong bullish advance. And remember, these two prior periods were not coinciding. Well, technically, the 2012 period was post QE2, QE3, I should say. But this 2016 cycle and in 2017 after the election, that was not coinciding with any sort of quantitative easing. There was no stimulus. There's no liquidity injection. This was just pure, basically, essentially multiple expansion. Well, right now we're setting a base. We're breaking out from a previous high, and we haven't even gotten to the fact that there's roughly 4 trillion, being printed. Due to stimulus, actually it's going to be more. So if we go here, the reason why we'll go back and forth between the two slides, but essentially my thesis is there's the largest pile of cash in equity history sitting on the sidelines right now. And for those of you who don't know, all of US financial market cap combined total is roughly 50.1 trillion. So now this is a hypothetical scenario, but let's be conservative. Right now, there's currently 4.4 trillion sitting in money market accounts and brokerages, which is basically money on the sidelines, people waiting to get in. Then you have another 4 trillion in stimulus plus the 900 plus another 2 trillion. So that's roughly 6.9 trillion, which is what you see right here. Let's say somehow, either directly or indirectly, 3 trillion of that makes into the markets, just purely hypothetically. And then we have a 30-year bond bull market ending, and the entire treasury market is roughly 18 trillion. So let's say hypothetically, 15% of that gets, injected into markets. That's another 3 trillion. Well, that right there is 10 trillion in potential cash waiting to enter equity markets. Now, if you factor how much 20% is, 10 trillion is of 50 trillion, you come out to a roughly 20% potential increase to the upside conservatively. Well, my personal target is 35,000 in the next 16 months, but 20%, you can do the simple math, is actually 36,000. And there's even a target higher than that. So as crazy as it sounds, and I know there's obviously, everyone's cautious because we're always at an all-time high, but a lot of the sentiments that are being said right now, they were the same things that were being said back in 2012 before the huge breakout, and the same thing at 2016 before that huge breakout. Everyone thought Donald Trump would be elected and market would crash. It didn't. Everyone thought Biden would be elected and there'd be a major crash. And obviously with vaccine news, that's not going to happen. So, we're in bull mode now, and that's just a fact. And based on what we're seeing, if you count roughly, 29, 30,000. If you do a 20% extension from there, that's roughly, 35,000, 35,500, almost 36,000. So, and 20% on a historical basis is very low, because the two prior breakouts were 32% and 40%. So this just provides a little bit of context how everyone says it's overvalued and this and that. And yes, there are a lot of PEs out there that are getting on the elevated side, but once you put it in context, we still could have a lot of room to run. And so again, this right here is a hypothetical scenario, but I just want to provide some context. And I don't think 20% to the upside is unrealistic. So to me, I'm not bearish. I'm bullish equities right now. And I think actually, and I'll tie this into the macro thesis here in a little bit, but just keep in mind, this is how much money is on the sideline. And remember that as money leaves treasuries, it often leaves gold as well too. But here, let's go to so this is now the macro kind of convergence. What happens when we bring all these asset classes together? Well, this is what we come up with. This is obviously the DXY. It's the weekly chart. I know there's a lot, it's busy, so there's a lot to go through here, but this is obviously the 10-year channel. The 10-year channel did break. Obviously that happened. But interestingly, as we discussed before, when gold was when the DXY is at the bottom of this channel, that's when gold actually peaked at 2,100. And we pulled back to this orange major resistance support level, which is roughly the 88, 89 level. This goes back all the way to 2008. There was two prior resistance peaks. Could this potentially be two potential support bottoms? It could. And right now the chart is suggesting that it may be. I actually think it is. So although we broke down here on the DXY, gold not only did not go to its 2237, but it's actually having trouble breaking out, anywhere near 2000 even right now. It's having trouble just sustaining 1800. So to me, that is in itself a warning flag for gold. I think it should have already, if it was going to make a big move to new highs, it should have already done it. And even last time in part 5, I was starting to show, spread a lot of caution, because I was seeing signals that I hadn't seen since 2012, and I was getting deja vu, constantly over the past 2 months, remembering same headlines, same news, it's almost a confluence of once, and then when we were at 2100, every institutional investor was rushing in. Well, normally institutional money is smart money, but for some reason, when it comes to gold and Bitcoin, they seem to be the last one in, so.
Including Buffett?
Did he actually buy it himself, or was it his two?
Oh, I don't know.
It's
the first time they had a gold miner in their portfolio, I think.
Well, that's true, but he also goes for dividends, and there's other factors as well too. So I think longer term gold is obviously still has a place, but I'm talking about short term and medium term. There are some concerns. And the other thing is, on this chart is, if you look at the previous cyan circle, if you measure the actual time frame from when the MACD broke down across the center line to when it broke back above, it was almost exactly 4 years. Well, if you look now, we're forming a very similar pattern to that previous cycle, and we're coming up on the 4-year mark here pretty soon, in roughly, call it April, May. And if you also notice in the MACD, there are these 4 blue squares, these boxes. These signal MACD double bottoms, and what this actually is a physical manifestation of what we know as an Elliott wave, ABC corrective wave. So anytime you have a corrective ABC, you're going to see some sort of a MACD double bottom. And if you look and coincide, you'll see, here's A, B, C. And if you go here, A, B, C, and well, now we're forming the same pattern. There's A, there was a small b, and then a C. We're forming that same exact pattern, which is indicating that we are at a major dollar bottom here soon. Okay, now, if this were to show, you'd also see it in the stochastics, which you are. And if you look back, there's also a very similar pattern going back all the way to 08 period, where you also had a major bottom. And to some degree, there's one here too, but the middle spike is so large, it's above the center line. But nonetheless, it's the same pattern. And that also ended up being a major macro bottom.
Okay, and you're saying officially the inverse relationship is broken?
Correct, because again, if this were still holding true, first off, it wouldn't have gone from 1360 to 1730 while it's rising. That, of course, right there doesn't make any sense. And then if you look at gold, it should have continued on to 2237 on this final C wave extension, but it didn't. It's stalling, and that's also reflected in the previous charts that I'd covered.
Okay. So if we got a break below your 88.5, and you're not the only guy looking at it?
Sure, the whole world.
That's the line. Is that the line in the sand?
Yes, that is the line in the sand. At that point, if that happens, then you can kiss GFP goodbye. But I said last time, until that euro, holds, there's no confirmation, and it still hasn't held. So there needs to be some sort of a peak here forming soon, which actually ties into my next chart. This is the normal distribution. I talked about all previous euro peaks and dollar bottoms. They're roughly within a 9 to 17 week period, and within 2 standard deviations, with the mean being roughly 12 to 13 weeks. Well, why is this important? Well, we're actually about to have a blast from the past and come full circle here. This was actually my old global Forex parity chart of the DXY from part 3. And back then I said, I hypothesized that it would be a 37-month cycle between bottoms, and then that would potentially be a point at where a base would form. Well, sure enough, I said back then it would be roughly around March, April of 2021. Well, it turns out we're kind of in that time period right now. And if you look at the stochastics, every single green circle where a bottom formed, without exception, 100% of the time was a dollar bottom. So, there's a lot of, if it's going to happen, there's going to be some sort of a bottom form in DXY. It has to happen now. This is where it would happen. And as I said, this 12 to 16 week period, that means that's pushing us off into probably realistically April is when we would start to see any sort of sign. So if you see some sort of bottoming forming or a peak forming on euro in some sort of a plateau, that's when we would have plenty of warning time before it happens, is what I'm saying. So
it's interesting. I talked to a lot of cycle guys too, Alex, and they're all talking about the April time frame. If the equities are railing into April, that there could be some kind of problem that could bring in the peak. Maybe you're at your targets by then. But anyway, I'm hearing a lot about April and March. We have the spring equinox, and so I'm hearing a lot about this time, March, April time frame.
And these are, I just want to kind of tie everything together. Gold seems to be entering a similar period to QE3, which is a topping plateau. And if we look back at that chart, let me go back through this one. Gold actually peaked the day basically QE3 started. And I remember at the time, everyone thought gold was going to go to the moon and go to 2,500 and continue on. The same sentiments we're hearing now. And it actually ended up being a sell the news moment. And every QE3 or every QE had law of diminishing returns. Over time, they get less and less and less. And I think we're in that same pattern where QE5 was, barely a blip. It should have rocketed higher, and it didn't. And so this last and final one, I think we'll have some sort of consolidation back to the high 1700s before we have one more pop going up into whenever this new, QE6 announcement cycle will happen. It'll be in the news constantly.
Oh, yeah.
So on and so forth. So I think we could have another sell the news moment, and then that would potentially be that third and final peak around 1950, 1960. And then more importantly, this is a very important point that I want to send across. In moving forward, there is going to be a lot of inflation, but gold needs artificial stimulus in order to keep going. It's the lifeblood of gold. From a demand and from a money flow standpoint, you got to have a lot of money printing, whether through the Fed or Congress is irrelevant. They're both the same effect. And for that reason, from what I'm seeing in the Dow breakout, I actually think U.S. equities are going to actually be the best inflationary hedge, because if we get some sort of a dollar bottom, emerging markets are going to get hit. They're not going to outperform U.S. equities. They just can't. And the three primary demand drivers for the U.S. dollar are U.S. Treasuries, petrodollar, barrels of oil,
Right.
and ultimately U.S. equities. And some of the money outflows out of the bond market is going to go into U.S. equities. The 30-year bond bull is coming to an end. It's officially over. We called it on part 4, almost to the day. That was the end. That's the end of the bull market, because you reached roughly $1,000 on par value of your treasury bond. There's no more to go, and we're not going to go negative. So that was the bottom. And so now, how do you attract more capital in? The only way to do that is allow yields to naturally rise. So when the Fed says they're targeting 2% inflation rate, I don't think they just mean some arbitrary metric of 2 inflation. I think that's code for they want the 10-year to go to 2%. And at that point, and they even wanted to they will actually want it to overshoot and have an average of over 2%. So it could go 2.1, 2.2, 2.3. So to me, I think that's code. Like, they're literally going to allow this inflationary cycle to happen. And every recession has 3 phases. There's phase 1, which is the crisis. There's phase 2, which is basically consolidation, a low trough period in yields. And then phase 3 is when rising yields is not a negative signal, it's actually a positive signal, because it means inflation is now entering back into the system. And a lot of that inflation is going to be targeted towards the actual U.S. equity market. So to me, that's actually, now I hear a lot of people say, well, rising dollar is bad for equity markets. Well, let's look at the history. The 2 largest bull equity markets, so 2 very large bull equity markets prior to this huge spike, were during periods when the dollar was rising. .com, the dollar skyrocketed. And during the 2012-2014 period, when the markets were advancing, so did the dollar. So arguing that somehow dollar up equals down equities, that's not necessarily true. Correlations, they change depending on what the cause, the why of it is. I mean, why is the dollar rising? That's more important than if it's going up or down. Necessarily, it means inverse or not. So I just want to emphasize that I see, if the dollar is rising while U.S. equities are rising, it's naturally going to draw equity out of emerging markets, out of European markets, out of other markets, and into our equity.
Because you get the double bang, you get the appreciation and the currency.
Correct. And remember, gold is also
the opposite of what's been happening the last 6 months.
Correct, because we were going into it was phase 1, and then we were just finished phase 2. Now we're entering phase 3. It actually, all the correlations, they reverse in phase 3. That's what a lot of people miss. So now we're seeing huge inflationary pressures on Dow. My prediction is Dow will be at 35K within the next 16 months. And in that, I think the energy sector specifically had its best macro entry in over 35 years. I think we're entering a major bull for energy sector.
You have any upside targets that you can envision for WTI?
Yeah, it's going to go back above 100. I think it's going to go back above 100 in the next 4 years. Yes.
Okay. Does that include geo risk or just the recovery of global economy?
I'm glad you brought that up. This is important because all prior oil recessions were either some sort of economic shock or some sort of natural economic processes happening, whether it be Saudi flooding the markets, to start a price war and so on and so forth. These are kind of long drawn out processes. This is the first time in modern history where we had an artificial shock, one that was basically we chopped off a limb in order to save the body. And so when you do that, the supply demand cycle inverts much more rapidly than it would naturally. And our rig count is at, I think the lowest I saw was somewhere around 180 rigs. The last time we had that many rigs active was during the Great Depression. We've never had that many few rigs operating at one time, which means there's a massive, although there is technically a supply glut, the production takes a long time to come back online. You can't just turn it on like a switch. So when this huge, travel boom, leisure boom is going to happen once this is all over, come April, May, I think COVID will kind of start to become a thing of the past. You're going to see a massive swing in consumer behavior, and you're going to have everyone traveling and using energy consumption, and all of a sudden that supply curve and demand curve is going to flip. And remember, oil has inelastic demand, so minor shifts in supply have an exponential effect on price. It's the opposite of elastic market. So to me, I don't see why this is going to be the greatest demand shock and supply shock transition in such a short period of time we've ever had, because we're basically now turning the switch back on. But oil can't catch up. It won't be able to catch up as much. Plus, we got an extra benefit, cherry on top, this past week when Saudi said they're now cutting production. Surprise, 1 million barrel cut. And now they're cutting to Asia as well too, as of recently, I think yesterday. So all the macro economic triggers are there for a major energy bull market. And energy equity specifically over the past month have outperformed virtually every other sector, as have financials. And the reason financials have too is also because of rising yields. Yeah, exactly. So anytime in a F.A.C.E expansion, the best sectors to be in are financial, energy, and industrials, which if you look at the Dow, I actually think the Dow was going to outperform the NASDAQ over the next 16 months, because a lot of the laggards, a lot of the laggards that were sitting in the Dow. And keep in mind, Dow also has Apple and Microsoft too. So it's not that it doesn't have a tech component, but it's going to have a much stronger bullish momentum behind it, because it's not one of these high flyers. Most of the names were sitting at their 200-day moving average with low PEs, extremely high dividends. Every macro fund on earth is buying any 8%, 10% dividend they get their hands on right now, which are those are already gone now. So it's just kind of put everything in perspective. If euro ends up topping here in the next, it forms some sort of topping plateau in the next 12 weeks, that's when you'll know, okay, now it's time to start getting ready. All the indications are we still need a little bit more time. I think April is really kind of rough. And even when I'm in part 3, I said that was the previous cycle. I even showed the 4 years between, the MACD crossings. All the confluence signs are forming that this is kind of a major macro support, and 88 absolutely has to hold. I mean, that's just, it has to. So that's kind of my
presentation.
Thank you, and I appreciate it, Dale. And obviously, Charge Coach is my my platform that I launched. Kind of new little tidbit. I launched a bunch of new risk options and Dow calculators. If you want to try them out, they're completely free on the homepage. You can test it out, play with it. I also launched a new proprietary Dow Jones future price calculator on the backs of this huge breakout, where it's basically the only one like it in the world because I coded it from scratch. But it can accurately predict the Dow Jones future price based on all 30 components to the exact penny. So I coded that. I just launched that recently. It'll show prices dynamically in real time, so you can see what effect one specific Dow component has. You can kind of come up with your own price targets based on historical data, and it's accurate all the way to 6 decimal points. So if you want to use that, that's kind of something new. And I'll be launching a bunch of new calculators as well soon, historical calculators that go over 30, 40, 50 years of data, where instead of you having to manually wait for a price target, you can basically choose, based on historical data, put in the inputs, and it'll tell you where price action should go based on historical charts and whatnot. So it's kind of cool.
Are you a Renaissance man?
I'm trying.
So a lot of things that you do, buddy. And one of the things that I appreciate is that you come here and share your hard work with us. And
absolutely. And it's a big confluence period. I mean, this is kind of I think in the next best advice I can give from a currency standpoint is in the next few months, if you're playing for bips or, you're scalping, keep your trades tight. Don't plan for any huge bets yet. Save that for April. But if you want to kind of play this, if we form some sort of plateau, you'll see evidence of it here in the next few weeks. So keep your trades tight. You've got profits, take them. And then you'll see some sort. We'll have plenty of warning before a major macro reversal happens. So just as the previous announcer echoed, like you just be patient. You're better off being a tiny bit late than being really early in currencies and just getting murdered. So just be patient, and we'll see signs of it here soon, and hopefully by next rendezvous we'll have a lot more to talk about if this ends up actually happening. It'll be exciting.
You know what, buddy? Your metaphor of a cut off a limb to save the body, which is what we did with COVID. I believe that's what you're saying.
Correct.
Right? So reminded me of a joke that God came to Adam and said, "I'm going to create a helpmate for you, a woman, but it's going to cost you an arm or a leg." And Adam said, "What can you do for a rib?" All right. Anyways, I thought, we got laughed too. So really nice presentation, buddy.
Thank you, Dale. I really appreciate it. Thank you so much. And keep doing what you guys are doing. I love your guys' work. It's amazing.
All right. Much respect here too. And good hunting, my trading warrior brother.
You too as well. God bless.
All right. Adios. See you guys tomorrow. Don't just count your pips, count your blessings. All right. Adios.